Hello everybody, welcome to Bitcoin Not Crypto. In today's video, I'm going to be showing off this tweet from Jeff Walton, who has thought really deeply about the idea of Bitcoin yield. This is one of the guys from MicroStrategy True North, or MSTR True North, and he shares this idea that he's come up with about Bitcoin yield and how there might be a way to do it that makes the most sense, and this is why he is interested in MSTR. I'm going to read his tweet in entirety, and I'm going to comment on it as we go along and add my own thoughts. And I'm also going to post this tweet in the comment section if you wanted to just read it, or this will be like the audiobook format of it. So here we go from Jeff Walton. Would you rather risk your time or assets in exchange for more time in the future? A thread on Bitcoin yield efficiency, debt risk, and time theory, balance sheet collateralization, the hurdle rate, and its application to MSTR for bulls and bears. TradFi and Bitcoiners are both bewildered about MSTR for different reasons. TradFi not understanding Bitcoin, and Bitcoiners not understanding collateralized debt and credit systems. This trade will be so obvious when looking back 10 to 20 years from now. The entire market of Bitcoin hodlers are focused on a single unified goal: how to get more Bitcoin. You have two options. One, spend time in exchange for dollars and convert to BTC, or two, leverage existing BTC stack as a collateral asset, in quotes here, read put at risk, in exchange for fiat dollars and convert to BTC. If you spend your time, you lose your time, and scale is limited, right? Time is the only more scarce asset than Bitcoin. If you leverage your assets, you can save time with much larger scale, your assets spending time working while you leisure. Considering time is the most valuable asset on the planet, how can one put its assets to work? Said another way, how can I avoid putting my time at risk in exchange for more time in the future? Putting assets to work can take many forms. In a traditional fiat dollar system, assets are used to start a business, buy a home, build things, lend, acquire more assets, etc. Enter Bitcoin. Considering Bitcoin is likely to be the most productive asset on the planet for the next 10 to 20 years, the solution to saving as much time as possible is very simple. How do I buy as much Bitcoin as possible, then put the Bitcoin assets to work with as little effort as possible in order to acquire more Bitcoin? That is, until you've banked enough future time. Now this is interesting, right? We can calculate time in the value of Bitcoin, and we can project that into the future where Bitcoin will be worth more and therefore will be redeemable in more time. All other forms of capital allocation are inefficient at the moment. In other words, Bitcoin is the hurdle rate for the opportunity cost of capital. Now, this is something I've been thinking about a lot, how Bitcoin is the hurdle rate, how we traditionally value assets appreciating compared to the S&P 500, which is just 500 of the biggest companies in America. I think that the real hurdle rate is Bitcoin. We've had, over the last 10 years, 66% compound annual growth rate. That's an incredible growing asset. We've seen a slowdown of that. However, the hurdle rate is still very high year over year, especially when we zoom out. And if you invest in anything else, you would want either it to have lower risk or higher returns. And to me, there's nothing fundamentally risky about Bitcoin. The code, the asset, the protocol, the place that we are in history of adoption, I see nothing that is fundamentally risky to the asset itself. There is volatility around it based on perception of what this asset is. But to me, Bitcoin is not risky in itself. It is volatile in the short term, but we can see that over time, the price goes up, and therefore we should evaluate it as not being risky. It's kind of a mind trick thing that you have to do because we've been conditioned and we've learned that volatility is risk. But volatility is one type of risk. Jeff continues here. In a traditional fiat system framework, building a business and employing humans as assets is a more productive venture than holding dollars. Pretty much anything is more efficient than holding fiat dollars. In a hybrid Bitcoin system, most humans are far less efficient than Bitcoin's CAGR and less efficient than using Bitcoin as collateral for now. In other words, the opportunity cost of all capital must be compared to a long-term Bitcoin strategy. Very few ideas are more efficient than buying Bitcoin and leveraging Bitcoin as collateral. This is why we are seeing so many lending platforms / collateralized finance platforms hit the market. Cantor Fitzgerald, OnRamp, Arch Lending, Debify, Ledn, SAB122, which means that bank custodies Bitcoin and future LOCs, etc. The Bitcoiners are starving for yield utility. BTC hodlers understand the risk and want to maximize their assets, time, and opportunity costs of capital. Now, I would say that he's being general here. I think that a lot of Bitcoin hodlers do not understand the risk of lending, and a lot of them do, but aren't starving for that yield. So there is a subsect of Bitcoiners who are looking for Bitcoin yield and utility, and that's why there's been these products that have come to market or have been on the market. And I think a lot of people are still very weary of these yield generating products. Now there's a catch and a primary problem the market is aiming to solve right now. Much of the Bitcoin market is hyper-focused on traditional lending products to retail and commercial businesses. In quotes, in brackets, take out a line of credit using Bitcoin as collateral. The problem is very few traditional fiat dollar capital providers are willing to take on volatile crypto lending and time horizon risk, thus resulting in a difficult product to sell to Bitcoiners. High interest rates, low loan to value, liquidation triggers, short-term horizons, etc. Now, this is definitely the biggest problem. When I see people pushing these lending products for Bitcoin, the loan to value, you have to put up a huge amount of your Bitcoin as collateral to get a very small loan, and the interest rates are higher than what I can get for a non-collateralized line of credit. So to me, they are not a product worth doing. But that's because they haven't broken into the fiat lending system as of yet. He continues here, but Bitcoin is the best collateral on the planet. Why won't these TradFi idiots understand? This is the question he's posing. Bitcoin is the best collateral on the planet, but most of TradFi world is too ignorant to do more than an hour of research on a new asset class to fully grasp the power of the asset. We've seen all the excuses: too volatile, too risky, the government will shut it down, it'll get hacked, who is Satoshi, it's tulips, Ponzi. I'm honestly not surprised at all. At its core, fiat dollar lenders don't want to lend out risk on their dime for borrowers to buy more Bitcoin assets and destroy the very fiat system that keeps them in business, all with the unprecedented risk levels and an impossible to manage systemic risk. Asking fiat capital providers to take on this kind of risk is a very difficult value proposition for the capital markets, with very low relative return, high vol, high risk, low return. So it's not in their best interest to even do this, because who are the people that they're lending to? They're lending to Bitcoiners who can handle volatility. What will those Bitcoiners do? They will take on additional risk with the loan that they're taking on. Will that risk pan out? I mean, we can look even further out on the risk curve, right? Going into crypto. If a crypto person takes on a loan, what are they going to invest in or trade? They're going to trade crypto assets, and a lot of them are worth absolutely nothing. Whether they're valued at that moment at that level, that's what they're intrinsically worth. And so there's a lot of opportunity for bad loans to happen because of who the people are that are taking the loans. So in a fiat dollar lender is seeing that customer and not really saying there's a lot of value here, there's a lot of business to be had here. Let's stick with the fiat system. We can lend to bigger institutions, do bigger lends, and have other types of assets be the collateral. In comes the corporate balance sheet, the transformer. The corporate balance sheet is able to transform Bitcoin held on balance sheet into various different risk forms, volatility tranches, that are far more palatable to traditional financial markets. Low vol, low risk, moderate return. The positioning within the capital structure has now been transformed into layered forms of collateral adjacent to the Bitcoin holdings with different risk functions, debt, preferred stock, and common. This is a brilliant solution. It is a classic case of meeting unmet need in markets. The traditional financial markets understand that they need some exposure to Bitcoin and crypto, even if it is a small scale or alternate, less volatile forms, thanks to Markowitz's modern portfolio theory. This is to diversify to lower the total amount of risk of portfolios and up the returns. The traditional market is tasked with getting exposure to the best asset on the planet with varying forms of risk/return metrics, i.e. dip their toes in the water. You know what risk that is a lot easier to underwrite than the volatility of Bitcoin? Debt covenants on a company, MSTR, with $45 billion of assets and $8 billion of debt, a 17% leverage ratio from the debt to equity. Let MSTR and common stockholders take on excess Bitcoin volatility risk. Risk underwriters will not get fired for taking on debt or preferred stock for a company with $45 billion of assets and $8 billion of debt, even if the assets are in Bitcoin. The leverage ratio and financial strength are just too incredibly strong. This is something that a lot of people that look at MSTR fundamentally get incorrect. They do not realize how strong of a balance sheet MSTR has. They will get fired, however, for underwriting a poor retail Bitcoin loan where the buyer YOLOs his account on leveraged Farcoin. The picture a bit more clear now. MSTR and Bitcoin Treasury Co's are solving a massive unmet need in traditional financial markets, exposure to Bitcoin risk with alternative, less risky structured vehicles. He's talking about preferred shares, he's talking about convertible debt, he's talking about traditional debt, all sorts of financial instruments with less risk, less downside, and not as much volatility and upside either, but it's something that they can handle and put into the traditional markets. The buyers of these vehicles and BTC exposure are holding these positions as assets on their balance sheet. MSTR debt/preferred stock is an asset. This is the most efficient form of leveraging Bitcoin as collateral, putting the assets to work within a risk framework that maximizes time and efficiency. MSTR, along with other Bitcoin treasury companies, will continue to show the highest Bitcoin yielding forms of leveraging Bitcoin as collateral for the foreseeable future, period. Not all will succeed, some will fail. This is not foolproof. Prudent risk management will continue to be the ultimate focus of any Bitcoin treasury company. This is what MSTR talks about when they say intelligent leverage. They're talking about prudent risk management of debt compared to assets. Just take a moment to consider the future of BTC cycles, where BTC treasury companies appropriately manage risk and continue to leverage their balance sheets as collateral during bear markets, accelerating Bitcoin's success as digital capital. It will happen, it's just a matter of when. I'll leave you with this. Bitcoin has become the hurdle rate. It is very hard to beat Bitcoin. Leveraging assets as collateral with strong risk framework is the most efficient use of time to meet/exceed the hurdle rate. In the meantime, most everyone else is risking their most precious resource, time, in exchange for more Bitcoin. This was an incredible thread here on Jeff Walton's Twitter. Incredible. I mean, he just absolutely blew it out of the park here. Really reframing the idea of what Strategy is doing and what Bitcoin treasury companies are doing and how it's a better option doing it in this corporate world where they can offer these larger, more not complex, but more necessary for the rest of the markets out there, instruments of debt. if you take on personal debt to buy Bitcoin, that's just, I mean, if you do a line of credit, right? That's not backed by any collateral. It's backed by you as somebody with a credit score. It's backed by like reputation. It's backed by history, and it's backed by character, I guess would be a way to put it. And that's not a very profitable debt instrument. It's not a very low risk instrument, and it's not clear to the debt holder of that that's exposing them to Bitcoin, and they don't see the upside of the Bitcoin if you take out a personal loan to buy Bitcoin. With this, it's very transparent what MSTR is doing and what other Bitcoin treasury companies are doing. It's very transparent. They have all of these assets that are Bitcoin, right? If a company wants to expose themselves to Bitcoin, they can now choose to do that by holding a MSTR asset on the buyer side. This is an asset, a debt instrument, a preferred share that is paying 10% a year or paying $8 a year based on share price, depending on the preferred share they buy. These are assets they can buy. They can know transparently that they are attached to Bitcoin. They see some upside of Bitcoin depending on the debt instrument they buy, based on the underlying of strategy being affected by Bitcoin's price. And it ups their reward for the debt that they are buying. It's an incredibly well put thought that Jeff has here. I think Jeff is one of the, he's still underrated in my opinion, one of the great thinkers in this space. I think he's underrated because he focuses so much on strategy, and people are so weary of what's going on with strategy still. People, and I think that's totally understandable. I think it's totally fair to be wary of what's going on. I think when we hear Bitcoin yield, we should throw up some, that should definitely be a red flag. We should start to think about this more deeply. We should read stuff like this. We should contemplate what is going on. We should look deeper into the financial markets. And when we do, we understand that this is a very good thesis. We've actually seen this play out and become very successful for what strategy has done. A year ago, look at the market cap of strategy. Look at the market cap now. I think it's 3 times just the net asset value, just the amount of Bitcoin they hold, the value of the Bitcoin they hold is 3 times basically what the market cap of the entire company was just a year ago. So it's incredible. I mean, don't quote me exactly on those numbers, but I mean, you can look back and specifically pick certain time frames and see that this has done extremely well for the company strategy and for a lot of the shareholders. You wouldn't know it by looking into irresponsibly long MicroStrategy. You'd be, these people have lost their shirts, but they're buying, close dated call options. They think this thing's going to 1,000 overnight. They think the God candles are loading, all of this. But if you step back and actually look at what strategy has done, what they continue to do, what they plan to do in the future, you will understand that they're an incredibly strong company that is able to wrap up Bitcoin in different instruments that are incredibly valuable to the financial market. And I think one thing here that is very important to look at as well is, what do you want out of your investments? Do you want to just use your time like you're doing when you go to work and put that time into an asset that is going to store its value and actually increase as the adoption curve continues, which is Bitcoin, and you will be rewarded for doing so? Or do you want to go beyond that and not just use your time, but buy an instrument, strategy for example, that is not just using their own time to earn more Bitcoin, but they're wrapping Bitcoin in debt instruments, in products, and they're able to acquire more Bitcoin for doing so. And you are adding more Bitcoin per share as a shareholder. Now you're going to see a lot more volatility with that one. It's really just dependent on you as an individual. I think it's very important to realize who you are, what will make you sleep easy at night, to understand that Bitcoin is the new hurdle rate. Will strategy continue to be able to outperform Bitcoin in parts? certain moments of time? I think yes. I think it has the potential to underperform and be more volatile in certain points as well. And I think it's really just on you as an individual to learn about these things and to think about which thing is right for you to own. Now, if you do want to just own some Bitcoin itself, the place where I buy Bitcoin and where I recommend people go is Bitcoin Well. If you use my code in the description, you'll actually get some free Bitcoin on sign up. And they're a non-custodial exchange, which means you don't open yourself up to third-party risk. When you send the money, they send you Bitcoin directly. If you want to preserve your seed phrase for generations to come, I would check out Stampseed. You can use my code in the description. It's BTC, not crypto 15, and get 15% off of their titanium seed plate stamping kit. It's the best in the biz. Thanks everybody for watching. Again, I will link this thread in the description. Thank you, Jeff, for your effort and work in creating this thread, for thinking this through, and for bringing some information that a lot of us don't have about the internals of the financial industry and what they're looking for, and reorganizing the way that people think. I think that's what Jeff has done a lot of, and I want to thank him for that, I guess. So thank you, and thanks everybody for watching, and we'll see you on the next one.